If you want to understand what is happening to gold right now, you cannot start with a chart. That is where most people go wrong. They open a screen, they see a metal moving up or down, and they think the metal is the story. It is not. Gold is almost never the story. Gold is the verdict. It is the thing that reprices after the real story has already begun somewhere deeper in the system, somewhere in the plumbing of money, debt, collateral, credibility, and fear. I have spent a lifetime learning that distinction. Most people look at markets the way spectators look at fireworks. They stare at the color in the sky. They point to the explosion. They talk about the brightness. They do not ask who lit the fuse, who paid for the powder, or why the crowd suddenly stepped back at the same time. I have never liked investing that way. When I buy a business, I do not begin with what people are shouting about. I begin with what they are depending on without admitting it. I ask what has to remain true for the present arrangement to keep holding together. Then I ask what happens if that arrangement starts to crack. Not in public first, but quietly, in the accounting, in the refinancing schedule, in the cost of carrying promises that were made in a cheaper era. That is the frame I want you to use here. Because what matters is not that gold has had a dramatic move. What matters is why. And the reason is not simply inflation or fear or some fashionable slogan about hard assets. The reason is that the monetary system itself is beginning to behave like a heavily indebted household that is still smiling at the dinner table while moving credit card balances from one account to another in the kitchen. The smile can last a while, the arithmetic cannot. When I was younger, I learned a simple truth that has served me better than any dramatic forecast ever could. If you want to know where a system is headed, do not listen first to what its managers say. Look at what they are forced to do when the room gets quiet. Public language is for reassurance. Forced action is for survival. And when I look at the present environment through that lens, I do not see a random gold rally. I see a system that has started to reveal the choice it is trying not to name. That choice is very simple. Either you allow the debt burden to express itself honestly through tighter liquidity, higher refinancing pain and market breakage, or you soften that pain with newly created money, official support and balance, sheet accommodation dressed up in cleaner language. Most institutions will talk as if there are many elegant paths between those 2 points. In the end, when the numbers grow large enough, there usually are not. That is why this moment matters. The Federal Reserve can call an Operation Reserve Management if it wants. It can wrap the action in technical language. It can explain that the objective is smooth market functioning, liquidity transmission, or short-end stability. I do not object to the wording. I simply refuse to be hypnotized by it. If new money is created and used to absorb government debt, I care less about the label than the mechanism. The mechanism is the truth. And once you understand that mechanism, gold stops looking like a shiny relic and starts looking like a measuring stick for confidence in paper claims. That is the total mother line of this story. Gold is not merely rising because people are excited. Gold is responding because paper promises are becoming harder to finance. Honestly, I want to walk you through this the way I would explain it to someone sitting across from me, someone who does not need drama, does not need slogans, and does not need a prediction designed to impress. They need the machine explained clearly. They need the numbers translated into reality. They need to know where the weight is building, why that weight matters, and how a smart person should think when the crowd is still arguing about headlines. Let us begin where the pressure begins. A great many people still think central banks control events the way a man steers a car down an open road. Turn the wheel, press the pedal, tap the brakes, everything responds. That is a comforting picture. It is also incomplete. A central bank is often much closer to a pilot trying to land a damaged aircraft with too much fuel, a weak crosswind forecast, and a runway that keeps getting shorter. For years, the United States enjoyed the luxury of financing itself in a world that wanted dollars, trusted treasuries, and tolerated the idea that debt could grow faster than discipline because the system around it still looked superior to every alternative. Low rates made excess feel manageable. Long maturity structures masked pain. Asset inflation made households feel richer. Deficits looked abstract. then the price of money changed. That changes everything. When debt is small and rates are low, bad habits can dress up as strategy. When debt is enormous and rates are no longer near zero, strategy gets dragged back into arithmetic. This is the part ordinary investors often skip because it feels dry. It is not dry, it is the whole story. When the federal government must refinance trillions of dollars in maturing debt at rates far above what it paid during the easy money era, the cost does not sit in a textbook. It lands in the budget, it competes with everything else, it compounds, it becomes a bill for the past that grows faster than the room people thought they had to pay it. If you are rolling over roughly $10 to $12 trillion of debt into a rate structure around 4 to 5%, you are no longer discussing theory. You are discussing a conveyor belt feeding higher interest expense into the fiscal core of the country. That is not a one-quarter inconvenience. That is a structural pressure. And when annual interest expense crosses a level that would once have sounded absurd, when it begins to rival or exceed major national priorities, you are staring at a government that is increasingly working for its creditors before it works for its citizens. People hear that and still imagine the solution is mostly political. It is not. By the time the numbers reach this scale, politics becomes the theater around the arithmetic. The arithmetic remains the script. Now place that beside the central bank. After years of prior intervention, after years of bonds bought under earlier conditions, the Federal Reserve itself is no longer standing outside the problem as a clean referee. It has exposure. It has a balance sheet shaped by yesterday's crisis. It pays interest on reserves at levels that can exceed what its older assets earn. In plain English, it can wind up paying more for the stability of the system than it receives from the paper it already holds. A private firm that tried to run its affairs that way would not be praised for sophistication. It would be recognized as carrying a very expensive mismatch. Yet institutions can survive longer than households because institutions write their own language around discomfort. They can rename losses, they can postpone recognition, they can tell the public the structure is functioning, even while the gears inside are grinding. I do not say that as an insult. I say it because investors must learn to separate the courtesy of official communication from the brutality of official necessity. Once you do that, a great many things become obvious. If the banking system needs liquidity, if Treasury refinancing needs dependable demand, if private absorption is thinner than it used to be, if foreign appetite is less automatic, and if the government cannot tolerate a disorderly jump in financing stress, then sooner or later someone inside the system begins creating support. That support may arrive quietly. It may arrive in increments. It may arrive with a name designed to keep the public from hearing the older, more charged words. But money does not care about branding. Markets care about sequence. Gold certainly does. That is why I say the real event here is not a metal going up. The real event is that the guardians of the dollar system are beginning to behave like men managing a strain they cannot fully admit without inviting a larger panic. And when that happens, the few assets that sit outside direct paper liability start to matter in a different way. This is where many people become simplistic. They hear that and immediately say, "So gold always wins." No, I do not believe in fairy tales, and I have never liked investing theories that promise one permanent winner. Gold can go through violent resets. It can scare weak hands. It can spend long stretches doing very little, while other assets look more glamorous. It can correct hard enough to make impatient owners feel foolish. But if you ask me what gold is really measuring during periods like this, my answer is straightforward. It is measuring the market's growing recognition that the cure for an over-leveraged sovereign structure is rarely honest austerity. At full scale, the cure more often is managed dilution, yield suppression, quiet accommodation, and a long effort to make nominal burdens more tolerable by changing the value of the unit in which those burdens are denominated. That is a fancy way of saying this. When there is too much paper and too little political tolerance for pain, the paper tends to get cheaper. Gold has spent centuries understanding that before economists built elegant language around it. Now let us go one level deeper, because the story becomes even more powerful when you place the Federal Reserve's behavior beside what central banks around the world have already been doing. Whenever I see sovereign institutions buying the same reserve asset in size for years, I pay attention. These are not emotional buyers. They are not watching a thumbnail on a phone at midnight. They do not care about a one-week chart pattern. They are making statements about trust, settlement, sanction risk, reserve composition, and long-term optionality. For several years, central banks have been buying gold at a pace that is historically remarkable that did not happen because they became nostalgic. It happened because the world received a brutal lesson about reserves. A reserve asset is only neutral until it is not. A great many policymakers around the world watched what happened when Russia's foreign reserves were frozen and arrived at a conclusion. No public relations office can erase. If your core reserves exist inside a system controlled by a geopolitical rival, then those reserves are not fully yours in the only moment when ownership really matters. That is not ideology. That is risk management. Physical gold is different. It does not depend on the goodwill of a foreign institution to settle its own identity. It has no board meeting that can vote your access away. It is not a promise issued by the country whose sanctions you fear. It is an asset without counterparty language at the core. Now, that does not make it magical. It does make it uniquely useful in a world that is fragmenting. This is why I believe many investors misunderstand the current move. They think the Fed story and the central bank gold story are separate. They are not. They are layers of the same road. One layer says the debt. Heavy reserve, currency issuer is being pulled toward renewed accommodation. The other says the rest of the world has already begun hedging the political and monetary implications of that fact. When those two layers operate together, gold is no longer responding to a single catalyst. It is responding to a changing structure. And then, as if that were not enough, the oil market walks in with a can of gasoline. I have seen this before in different forms. People tend to underestimate how much energy shocks can accelerate monetary stress. Oil does not just make motorists angry. It works its way through shipping, manufacturing, food, margins, consumer sentiment, political pressure, and inflation expectations. It raises costs while weakening the tolerance for tight policy. It punishes the very economies already most exposed to dollar funding and imported energy. That combination is deadly for stability. If inflation rises because energy jumps, central banks are supposed to remain tough. But if the same energy shock also weakens growth, stresses refinancing, and threatens financial plumbing, toughness becomes expensive. Now you understand why gold responds so violently to oil-linked tension. It is not merely that inflation may rise. It is that central bank credibility gets cornered. A central bank is strongest when it can choose between competing objectives. It is weakest when all available choices are bad, and the market understands it. That is the threshold I want you to pay attention to. I call it the control threshold. Before that threshold, the market still believes the central bank is steering. After that threshold, the market begins to realize the central bank is mostly absorbing. That change in belief matters more than 100 speeches. Once investors conclude that the authorities are no longer choosing their actions from a position of strength, but are instead being driven by rollover math, liquidity dependence, and the need to prevent breakage, the price of gold begins to reflect something larger than ordinary inflation anxiety. It begins to reflect weakened confidence in the discretion of the system itself. This is where I want to introduce the framework that, in my view, makes the whole sequence understandable. You can think of the present gold bull market in 3 phases. The first phase is the quiet institutional repositioning phase. This is the period in which the most sophisticated buyers move first. They do not announce a grand panic. They do not wait for retail consensus. They do not need headlines. They see the drift of the world and they begin rearranging their reserves and exposures. Gold rises, but the rise still feels debatable to the public. People argue about real rates and the dollar and opportunity cost. They treat the move as interesting but not definitive. That phase has been with us. The second phase is the forced recognition phase. This is where the market realizes policy is not merely flexible. It is trapped. The authorities are no longer presenting options. They are revealing constraints. Purchases that sound technical begin to look directional. Debt service becomes a live issue, not a background line item. The bond market becomes less willing to play the old role at the old price. Gold stops being an optional inflation hedge in the public mind and starts becoming a required monetary hedge. That phase, I believe, is forming. The third phase is the credibility event. This is the phase people either sensationalize or refuse to discuss. I prefer to discuss it carefully. It is not guaranteed, and it is not necessarily immediate, but it is the destination of the road. If structural reform fails and accommodation becomes the standing answer to every new financing strain. In that phase, the market fully grasps that the system cannot honestly carry its burden at prevailing rates without assistance. Government debt begins to behave like a patient that cannot breathe without oxygen. The central bank becomes the buyer of necessity rather than the referee of optionality. Currency confidence erodes in waves. Gold no longer rises because specialists understand the mechanism. It rises because everyone else finally does. By that point, easy prices are gone. That is why I have always believed that certainty is the most expensive commodity in markets. By the time people feel certain, the bargain has usually disappeared. Now let me make this even more practical. A smart investor must ask not only whether the thesis is right, but where the opportunities and the traps are inside it. Gold itself is the cleanest direct expression of the thesis. It is simple, it is old. It is outside the operating risk of a management team. If what you want is monetary protection, it does that job directly. But every cycle produces another opportunity the public usually notices late. Gold miners, here the arithmetic becomes very interesting. When the gold price rises meaningfully above the cost structure of a miner, the miner's economics can improve much faster than a move in the commodity can produce a much larger move in margin. Revenue expands, but margin can expand disproportionately. Free cash flow can start behaving like it found a second gear. That is real leverage. Yet the market often refuses to reward miners early because mining is messy. There are jurisdictional risks, operational mistakes, capital allocation blunders, and company-specific landmines everywhere. That skepticism is healthy. Still, when the metal price is high and investor participation in mining shares remains muted, I become interested. Why? Because that is often what the inside of a real bull market looks like. The underlying economics improve before the public narrative catches up. The smart money studies margins. The crowd is still staring at last year's obsession. I am not telling anyone to buy miners blindly. I have seen too many people mistake operating leverage for certainty. What I am saying is that when a sector is earning far more money than the public is pricing into its shares, the mismatch deserves attention. And notice the emotional setup around all this. Retail investors have spent years training their imagination toward technology, software, artificial intelligence, and every story that promises acceleration without wait. Gold and miners demand a different psychology. They ask for patience, balance, sheet literacy, and a willingness to own something, because the world is becoming more fragile, not more exciting. That is not fashionable. It is often profitable. Now let us come back to the heart of Buffett's style thinking, because I do not want you to leave this as a macro spectator. In every market story, I ask the same questions. What is the mechanism? What is the incentive? What is the constraint? Who is being forced? Who still has a choice? And which parts of the market are being priced as if the old world still exists? The present gold story answers those questions cleanly. The mechanism is quiet monetary accommodation against a debt structure that is getting more expensive to carry. The incentive is obvious: prevent disorder in refinancing, preserve liquidity, and keep the system functioning. The constraint is arithmetic: too much debt, too much rollover, too much sensitivity to rates. and too little appetite for a truly honest reset. Who is being forced? That is the important one. The public is being slowly forced to relearn what money is. The Federal Reserve is being slowly forced to show its hand. Foreign central banks are being slowly forced to diversify reserve logic energy. Importing nations under stress can be forced to sell reserves in the short run, even while maintaining the long-term logic for owning them. And ordinary investors are being forced to choose between narratives. One narrative says all of this is manageable, technical, and already contained. The other says the system has entered the stage where official language lags official necessity. I know which narrative I trust more. I trust behavior. And behavior is now telling us something very important. The people closest to the system are already acting as if reserve quality matters more than before. That is not noise. That is information. Let me also address the biggest mistake I expect many investors to make. They will wait for the thesis to feel comfortable. They will tell themselves they want more confirmation, a cleaner entry, a calmer chart, a friendlier headline, a more obvious public consensus. They do not realize what they are saying. They are saying they want the market to remove uncertainty before they buy the asset designed to hedge uncertainty. That is backwards. You do not buy fire insurance after the house has started smoking through the roof. You buy it when the wiring still looks fine to everyone else. I am not suggesting recklessness. I have never admired that trait. I am suggesting intellectual honesty. If you believe the debt arithmetic matters, if you believe quiet balance, sheet accommodation matters, if you believe reserve diversification matters, if you believe oil shocks can accelerate credibility stress, then you must also admit that waiting for universal agreement is simply another way of paying a higher price for emotional comfort. Most people do that in markets. They do not buy conviction. They rent reassurance. It is one of the most expensive habits an investor can have. There is another layer here that I think matters greatly, especially for younger people who have only known a world of policy rescue. They assume every problem can be solved without consequence because every problem in their investing lifetime has eventually been papered over, backstopped, or inflated away. What they miss is that rescue is never free. The rescue itself becomes the tax. Maybe not through a line item on your statement, but through weaker currency quality, distorted asset prices, larger wealth inequality between owners and non-owners, and a financial system that becomes more dependent on perpetual intervention just to maintain appearances. Gold is not merely a trade against that trend. It is an indictment of it. That is why central banks buy it in size even when official rhetoric remains calm. They are not buying a story. They are buying an exit from single system dependence. Once you understand that, you stop asking the shallow question, is gold too high? Instead, you ask the intelligent question relative to the long-term dilution and credibility risk embedded in the system. How much monetary insurance is already priced in and how much is still being ignored? That is a better question. And because I have spent most of my life preferring better questions to louder answers, it is the one I care about. Now, let me tell you what I believe a disciplined person should do with all of this. First, stop thinking of gold as a toy for frightened people. That is a lazy caricature. Gold is a reserve asset. It is a monetary hedge. It is a ballot cast against paper overconfidence. Treat it with seriousness, not with superstition. Second, understand the difference between owning gold and worshiping it. I do not worship any asset. I do not need to. Good investing is not devotion. It is proportionality. Gold can be important without being everything. It can be necessary without making every other asset irrelevant. Third, remember that a reset inside a bull market is not the same thing as the death of the thesis. This matters enormously. Markets do not move in straight lines. Forced selling, liquidity events, margin pressure, policy confusion, and short-term dislocations can all hit even the best long-term thesis. Weak owners then conclude the thesis failed, when in reality the ownership structure simply got cleaned out. That happens in stocks. It happens in commodities, it happens in currencies, it certainly happens in gold. So if you own monetary insurance, you must know why you own it. Otherwise, you will surrender it during the first unpleasant drawdown and buy it back only after it feels socially approved. That is how people turn a hedge into a regret. Fourth, if you want to look beyond bullion itself, study miners like a business owner, not a gambler. Look at cost discipline. Look at jurisdiction. Look at management quality. Look at balance sheets. Look at how much of the current metal price is flowing into real cash generation rather than promotional language. The crowd tends to treat miners like lottery tickets. That is precisely why disciplined study can matter there. Fifth, do not ignore the broader portfolio implications. If the thesis is even partly right, this is not only about gold, it is about how you think about every dollar-denominated claim you own. It is about duration risk, bond sensitivity, real asset exposure, energy, defensive cash flow, and the difference between nominal return and preserved purchasing power. Many people have portfolios that look diversified only because the line items have different names. In reality, they are one giant bet on the continuing credibility of a single monetary structure. That is not diversification, that is repetition. The world is reminding investors of that fact. I want to close by saying something that may sound old-fashioned. I do not mind sounding old-fashioned when I know arithmetic is on my side. Wealth is not built merely by chasing what is rising. It is preserved by understanding what a system can no longer do without changing itself. The system we are living in can no longer carry endless debt growth, large refinancing needs, rising interest costs, geopolitical reserve distrust, and energy shock vulnerability, while pretending that every policy adjustment is just a harmless technical maneuver. At some point, the adjustments reveal the truth. I believe we are living closer to that point than most people understand. Not because of one speech, not because of one headline, not because of 1 week's movement in gold, but because the incentives, constraints, and behaviors are lining up in a way that tells the same story from multiple directions. The Fed's behavior is telling you, foreign central banks are telling you, oil is telling you, debt service is telling you, the bond market is whispering it, gold is simply translating it into a language the public cannot ignore forever. That is why I would not spend my time arguing about whether this move is fashionable. Fashion has never interested me, structure has. And structurally, we are in a world where money must work harder to remain believable, where debt must be managed more delicately to remain serviceable, and where assets outside direct paper promises become more valuable, not because they are exciting, but because they are independent. That is the essence of the opportunity. The destination is not determined by tomorrow morning's chart. It is determined by whether the system can restore discipline without breaking itself. I do not see that path as easy. When the easy path disappears, policymakers usually choose the survivable path. The survivable path is often inflationary, accommodative, and quietly dilutive. Gold understands that path very well. So if you ask me what the Federal Reserve just did to gold, my answer is this. It did not merely move the price. It changed the conversation from theory to mechanism. It gave the market another piece of evidence that the era of pretending debt can remain this large and yet remain morally and monetarily neutral is drawing to a close. And when a system starts revealing that truth, I do not rush to applause or panic. I do something much simpler. I follow the arithmetic. I follow the incentives. I follow the forced actions. Then I place my capital where human promises are weakest and real constraints are strongest. That is how I have always tried to invest. And in a world like this, it is how I would think about gold. Now,